Welcome to the lecture on fiscal policy. It is also called as public financing. In this lecture, we will discuss about meaning of fiscal policy, objectives of fiscal policy, automatic stabilizer and discretionary policy, fiscal policy instruments, types of fiscal policy, and limitations of fiscal policy. Meaning of fiscal policy. It is a tool used by central government in managing revenues and spendings for benefit and growth of economy. Revenues comes from income tax, corporate tax, GST, and others such as penalties. Spendings, where government uses the funds, so current expenditures, capital expenditures, and transfer payment. Current expenses or regular expenses. Capital expenses means investment in infrastructure. Transfer payment means one-side payment which does not contribute to the growth of economy. If revenue is greater than spendings, then there will be surplus budget. If revenue is less than spendings, then there will be budget deficit. And if revenue is equal to spendings, then there will be balanced budget. Let's check where money comes from. Major portion is from taxes and remaining from other sources. Where government spends money, major portion is given to the states, defense sector, subsidies given to the people, etc. What are the objectives of fiscal policy? Maintenance and achievement of full employment, maintenance of price stability, rapid economic growth, equal distribution of income and wealth, that is income equality. Next, automatic stabilizer versus discretionary stabilizers. Automatic stabilizers or non-discretionary stabilizer. The market stabilizes automatically. Government need not make any changes in the policy. Fiscal policy is framed in such a way that economic challenges get solved automatically. For example, introduction of taxation, whether it be a personal tax or corporate tax. When income increases, they have to pay more taxes, therefore it is automatic stabilizer. If GDP is falling, it will stabilize automatically, and if GDP is over increasing, then it will control by itself. During recession period, when GDP is falling and aggregate demand is also falling, government reduces the taxes so that disposable income will be more. People will start demanding more products. There will be more production to meet demand. More production require more employees. Production increases. There will be increase in GDP and employment increases. So national income increases. During the period of inflation, to control price stability, government introduces new taxes. There will be lesser disposable income available with the people. People will demand less, and businessmen will start selling goods at lower prices. inflation will get controlled. In discretionary stabilizers, government takes some measures. For example, if government spends more on infrastructure, there will be rapid economic growth, and if government reduces the tax rate, there will be more disposable income available with the people. People will start demanding more, businessmen will start producing more, there will be growth in GDP, and ultimately economic growth. So government influences the economy either by changing the level of tax or types of tax, or by changing spendings. The GDP formula is consumption plus investment plus government spendings plus net exports. Net exports means export minus imports. In this formula, only government spendings can be directly influenced by the government. What are the tools of fiscal policies by which government influences the economy? By way of government expenditure, taxes, public debt, and government budget. First point, government expenditures towards consumption, investment, and transfer payments. Consumption refers to revenue expenditures. It means to pay regular expenses. Investment refers to capital expenditures. For example, investment in infrastructure projects. And transfer payments, which are one-side payments which does not contribute to the GDP. For example, subsidies given to the people or social securities, etc. Let's discuss about 2023-24 budgets. Here, revenue expenses and capital expenses are given. Revenue expenses are used for consumption purpose and capital expenses for investment purpose. Just I give you example infrastructure projects, etc. Even we can see that revenue receipts are less than revenue expenditures. Revenue receipts are less than revenue expenditures. It means there is deficit in the budget. Similarly, capital receipts are greater than capital expenditures. So there is surplus budget. Here you can see expected expenses versus real expenses and capital receipts expected versus actual. Next, by way of taxes. During recession, for individual, government reduces income tax. People will have more disposable income. People will start demanding more. There will be increase in production and ultimately increase in GDP. Similarly, for companies, government reduces corporate tax. They will be left with high net profit. Companies will invest more and there will be more GDP. On the contrary, during inflation period, government increases income tax rate. People will be left with lesser disposable income. People will demand less. There will be reduction in prices. So automatically inflation will get controlled. Next, public debts as instrument of fiscal policy. It can be divided into internal debts and external debts. When government borrows money from general public within the country, it is called as internal debts. And when government borrows from outside sources, it is called external debts. Next, forms of public debts, by using which instruments government borrows money from public. So it can be divided into market loans, and small savings. In case of market loans, government borrows money by selling treasury bills, government securities, bonds, etc. Treasury bill is for short term and others are for mid and long term. Small savings by way of national savings certificate, etc. So these are the instruments by which government borrow money from public debt. Last, government budget as instrument of fiscal policy. Every year on 1st February, the government announces union budget. As we have discussed, revenue comes from different sources and government spends money in different ways. So if revenue and spendings are equal, we call it as balanced budget. If revenue is greater than spendings, there is surplus budget. And if revenue is less than spendings, then it is deficit budget. For example, if revenue is 1 lakh crore and spendings is 80,000 crore, then 20,000 will be surplus. Let's have a look on current budget of 2023-24. This budget focuses to boost agriculture startup, infrastructure for agriculture, crop protection insurance, to promote natural farming, etc. As we can see, government spends more amount every year. Therefore, production also increases. They have focused more on technological products like AI, national data security, DigiLocker, 5G services. Next, they have increased the exemption limit of direct tax. Next, allocation of expenses. They have given priority to defense sector, then transportation and infrastructure projects. Let's discuss about transfer payments. These are the funds which government utilized for betterment of society. For example, money allocated for vaccination. Next, Pradhan Mantri Awas Yojana. So we have discussed instruments of fiscal policy, government expenditures, current expenditure, capital expenditure, and transfer payments. Taxes by way of public debt, internal debt, external debts, and government budgets. Next topic, types of fiscal policy, expansionary fiscal policy and contractionary fiscal policy. Expansionary fiscal policy is used when there is recession in the market, and contractionary fiscal policy is used when there is inflation in the economy. Expansionary policy, according to classical economists, they say during the period of recession, production reduces, employment reduces, so wages reduces, overall cost of production decreases, and supply increases. As we can see, this is AD, aggregate supply. Aggregate supply has shifted rightwards, so equilibrium point has reduced. So price P has shifted to price P1. But Keynes argued that classical economists were wrong. The wage rate doesn't change rapidly. So according to Keynes, during the period of recession, the government should increase their expenses. Government expense increases, the wage rate will remain constant. So aggregate demand will increase and not the aggregate supply. Let's check. This is aggregate demand 1, aggregate supply 1. The aggregate demand shifted upwards, so equilibrium point shifted upwards. But during the period of lockdown, people left their job or cut in the salary. So classical economists were right at that time because during the period of recession, it affected wage rate. So what is recessionary gap and contractionary gap? Say for example, this is aggregate demand, AD, and this is aggregate supply, and this is aggregate demand at full employment. So this area is called as recessionary gap. So if present aggregate demand is less than aggregate demand at full employment, there will be recessionary gap. And if aggregate demand is higher than aggregate demand at full employment, there will be contractionary gap. Fiscal policy for long-term economic growth. Long-term economic growth can be achieved by increasing capital expenditure, that is, investing in infrastructure projects. Next, fiscal policy for reduction in income inequalities. Income inequalities can be reduced by way of taxation. As we know that there are two types of taxes, direct tax and indirect tax. Direct tax means income tax and indirect tax is same as GST. So direct tax, if government increases the taxes on higher slab rate, then more tax will be paid by the person who has higher income. So it will not affect the person with lower income. So wealthy person will pay higher tax. Government can increase indirect tax on luxury items such as luxury cars, precious metals, etc. So the person who buys the luxury products will pay higher tax. So as we know that direct tax is a progressive tax. It means when income goes on increasing, you have to pay higher tax. So government collects money from rich people and distribute among economic backward class. So we have discussed meaning and objectives of fiscal policy, automatic and discretionary stabilizer, fiscal policy instruments, types of fiscal policy. Let's start with limitations of fiscal policy. First point, existence of different types of lags. Lags means delays. It means when inflation is going on in the economy, government don't even recognize it. If they recognize it, they will delay the decisions. If they take decision, they will delay to implement the decision. And if they implement the decisions, impact will be delayed. So there are four types of lags: recognition lag, decision making lag, implementation lag, and impact lag. Wrong timing. Inflation is going on in the economy and government increases the tax rate. But at the time of introduction, inflation period gets over and recession starts. So it will hurt more. Next, rigid policy. Sometimes economy requires immediate action, but immediate change in policy may not be possible. Difficult to reduce government expenditure. It is not possible to reduce pension or salary of any defense staff, such as police, army, etc. Next, perpetual burden. Perpetual means lifelong burden. At the time of inflation, government sells government securities in the market, but at the time of maturity, it will create problem. Last, crowding out. When government requires money, they borrow huge amount from market. So there will be no loan available to the general public. So general public crowded out. Similarly, sometimes back government distributed laptops among the students. At that time, laptop manufacturing companies were crowded out. So crowding out means taking away from the market. So we have completed fiscal policy parts. Distinguish between monetary policy and fiscal policy. Meaning, monetary policy is used by central bank to regulate money supply in the economy. Fiscal policy is a tool used by central government in managing tax revenues and public expenditure for the betterment of economy. Second, managed by. Monetary policy is managed by central bank in India. Reserve Bank of India is the central bank. Fiscal policy is managed by central government. Next, measures. Monetary policy measures interest rate on lending money in the economy. Fiscal policy manages tax revenues and capital expenditure in the economy. Next, objectives. The primary objective of monetary policy is price stability, and fiscal policy objective is economic growth. So we have discussed monetary policy and fiscal policy in detail.